You work 40 hours, you earn a paycheck. You spend it on rent, groceries, gas, insurance, utilities. By the end of the month, there's nothing left, so you borrow. A credit card for the unexpected expense. A car loan because you need transportation to work. A mortgage because rent was going up anyway. You tell yourself you're building something, managing, staying afloat. But 6 months later, you're back in the same position. Paycheck gone, expenses covered, debt growing, and you borrow again. This isn't bad luck. It's not poor financial choices. It's the structure. The American financial system is designed as a closed loop. Wages are calibrated to fall short. Prices are engineered to rise faster than income. Credit is offered exactly when you need it. And the gap between what you earn and what you owe is permanent, deliberate, and profitable for the institutions that manage the cycle. Let me show you how the loop works, how it was built, and why breaking out of it isn't just difficult, it's structurally discouraged at every level. Before we go further, understand this. The loop isn't a conspiracy. It's a system. No single person designed it. No meeting of elites planned every detail. But over the last century, financial institutions, policymakers, and corporations solved their own problems in ways that locked American households into recurring debt. Each solution made sense in isolation. Together they created a machine that feeds on the gap between income and expenses, and that gap never closes. It widens slightly every year. Here's the pattern across history. In 1950, the median American household could buy a home for roughly twice their annual income. By 2020, that same home cost 8 times annual income. In 1970, a year of college tuition at a public university cost about 400 hours of minimum wage work. By 2020, it cost 4,000 hours. In 1980, healthcare spending was 5% of median household income. By 2020, it was 15%. Wages grew, but the cost of housing, education, and healthcare grew faster, and the gap was filled with credit. Mortgages, student loans, medical debt, credit cards. The system didn't collapse, it adapted, and the adaptation was debt. This is the loop. You work, you earn, you spend, you borrow. You work to pay the debt, and the cycle repeats. Let me show you how each phase of the loop was constructed, who profits from it, and why escape velocity is nearly impossible for most households. The first phase of the loop is wage suppression, not stagnation, suppression. Between 1979 and 2020, American worker productivity increased by 70%. Output per hour worked grew steadily, but median wages adjusted for inflation grew by only 17%. That gap, the 53% difference between productivity and pay, didn't vanish. It flowed elsewhere, to corporate profits, to shareholders, to executive compensation. The return on labor decreased while the return on capital. This wasn't an accident, it was policy. In the 1970s, American corporations faced a problem. Profit margins were shrinking, labor unions were strong, wages were rising, and inflation was eroding returns. Corporate leaders and economists proposed a solution. Weaken labor's bargaining power, shift production to lower wage regions, and return more revenue to shareholders. The term they used was maximizing shareholder value. It became the doctrine of American business. In 1976, the average CEO made about 30 times the salary of their median worker. By 2020, that ratio was 320 to 1. Profits surged, dividends increased, stock buybacks, which had been illegal until 1982, became standard practice. Companies used revenue not to raise wages but to purchase their own shares, inflating stock prices and enriching executives whose compensation was tied to share performance. Workers became a cost to minimize. Shareholders became the priority. Meanwhile, globalization and automation pushed wages down further. Manufacturing jobs that paid middle-class wages moved to Mexico, China, Southeast Asia. The jobs that remained in the US were often lower paid. Service work, retail, logistics, jobs that didn't require a union and didn't offer pensions. The result was a generation of workers earning less in real terms than their parents, despite being more educated and more productive. This is the foundation of the loop. Wages don't keep pace with productivity. The surplus value generated by workers flows upward, and households are left with less income relative to the cost of living. The gap opens, and credit fills it. The second phase is expense inflation. Not general inflation, targeted inflation in the categories that households cannot avoid: housing, healthcare, and education. These three costs have grown faster than wages, faster than general inflation, and faster than almost any other category of spending. And they're non-discretionary. You need a place to live. You need medical care. If you want economic mobility, you need education. You can't opt out. Start with housing. In the 1980s, financial deregulation allowed banks to offer more mortgage products: adjustable rate mortgages, interest-only loans, subprime lending. Home ownership was rebranded as an investment, not just shelter. Buy a home, watch it appreciate, build wealth. The demand for homes increased, prices rose, and instead of wages rising to meet the cost, lending standards loosened. You couldn't afford the home? Take a bigger loan. Can't afford the monthly payment? Take an adjustable rate that starts low and rises later. The financial system didn't say housing costs too much, it said borrow more. By the 2000s, home prices had detached from income. The price-to-income ratio, which had held steady for decades, doubled. Households borrowed 6, 7, 8 times their annual income to buy homes. The loans were packaged, securitized, and sold to investors as safe assets. When the bubble burst in 2008, millions lost their homes, but the structure didn't change. After the crash, investment firms bought foreclosed properties at a discount. Today, Wall Street landlords own hundreds of thousands of single-family homes. They rent them back to the families who couldn't afford to buy. Rent increased faster than wages, and the cycle continued. Healthcare costs followed a similar trajectory. In 1970, the United States spent about 7% of GDP on healthcare. By 2120, it was 18%. No other developed country spends more than 12%. The difference isn't better outcomes, it's system design. American healthcare is a for-profit system where hospitals, pharmaceutical companies, and insurers all extract revenue at each point of care. A single surgery can generate bills from the hospital, the surgeon, the anesthesiologist, the imaging center, and the lab. Each entity bills separately. Insurance covers some of it, the patient covers the rest. And if the patient can't pay, they're offered payment plans or medical credit cards. Debt. The Affordable Care Act expanded insurance coverage, but it didn't control costs. Premiums continued to rise, deductibles increased, out-of-pocket maximums grew. A family plan in 2020 cost over $20,000 per year in premiums alone before any care was received. For a household earning $60,000, that's 1/3 of gross income. And if someone gets seriously ill, the out-of-pocket costs can be another $10,000 or $15,000. The gap between income and medical expenses is closed with debt. Medical debt is now the leading cause of personal bankruptcy in the United States. Education costs exploded for a different reason. In the 1970s, state governments funded 70% of public university budgets. Students paid the rest through tuition. By 2020, state funding had dropped to below 30%. Universities raised tuition to cover the gap, and the federal government offered student loans to bridge the difference. The loans were guaranteed, non-dischargeable in bankruptcy, and available to anyone. This created a price spiral. Universities could raise tuition because students could borrow. Lenders made loans because the government guaranteed them, and students borrowed because they were told a degree was the only path to a middle-class life. By 2020, total student loan debt exceeded $1.7 trillion. The average borrower owed $30,000. Graduate students owed far more, and the loans carried interest rates between 4 and 7%. A student borrowing $50,000 for a degree could end up repaying $90,000 over 20 years. The debt couldn't be discharged. It followed borrowers through income fluctuations, recessions, job changes. And if they couldn't pay, wages were garnished. The degree was supposed to increase earning power, but wage growth didn't keep pace with debt service. The loop tightened. This is the second phase. Housing, healthcare, and education costs rise faster than income. Households can't avoid these expenses, and the financial system offers credit to fill the gap, not as a bridge, as a permanent fixture. The expenses never decrease. The debt never fully disappears. It's refinanced, rolled over, managed, but it persists. The third phase is credit access. The system ensures that when you need money, it's available. Not because financial institutions are generous, because debt is profitable. Credit cards, auto loans, home equity lines, payday loans, buy now, pay later services. At every income level, credit is offered precisely calibrated to what you can almost afford to repay. Credit cards are the most visible part. In 1980, the average American household had one credit card. By 2020, it was 4. Total credit card debt exceeded $1 trillion. The average interest rate was 16%. For subprime borrowers, it was 25% or higher. And the minimum payment structure ensured that balances persisted. Pay the minimum, and you're mostly covering interest. The principal declined slowly. A $5,000 balance at 18% interest, paid at the minimum, takes over 20 years to repay and costs more than $8,000 in interest. The card issuer collects more than the original purchase. The structure is deliberate. Credit card companies don't want you to pay off the balance immediately. They want you to carry a balance. That's the revenue model. And it works because households need the credit. When the car breaks down, when the medical bill arrives, when the furnace dies in winter, savings are often insufficient. So you borrow. The credit is approved instantly. The purchase is made, and the debt begins compounding. Auto loans follow the same logic. The average car loan in 2020 was $35,000 at 5% interest over 6 years. Total repayment, $41,000. And many households traded in cars before the loan was paid off, rolling the remaining balance into a new loan. Perpetual car payments. The vehicle depreciates, the debt remains, and transportation is non-negotiable. You need a car to get to work, so you borrow. Payday loans and high-interest installment loans target lower-income households. Borrow $500, repay $600 in 2 weeks. The annualized interest rate can exceed 300%. These loans are predatory, but they exist because the demand exists. Households living paycheck to paycheck face emergency expenses that exceed their cash on hand. Banks won't lend to them. Credit cards are maxed out, so they turn to payday lenders. The debt trap at its most explicit. In recent years, buy now, pay later services emerged. Purchase something online. Split the payment over 4 installments. No interest if paid on time. It's marketed as convenient and harmless, but it encourages spending beyond immediate means. And if payments are missed, fees accumulate. It's credit, repackaged for a generation that distrusts credit cards but still needs to bridge the gap between income and expenses. This is the third phase. Credit is everywhere, it's easy to access, and it's calibrated to maximize long-term profitability, not short-term repayment. The system wants you in debt, paying interest for as long as possible, and the structure ensures that once you borrow, you'll borrow again. The fourth phase is the debt service trap. Once you're in debt, a portion of your income is permanently allocated to repayment. Mortgage payment, car payment, student loan payment, credit card minimums. These are fixed monthly obligations. They come out before discretionary spending, and they reduce your ability to save or invest. You're working not to build wealth, but to service debt. Here's the math. The median American household earns about $70,000 per year. After taxes, that's roughly $55,000. Median rent or mortgage payment is $1,800 per month. That's $21,000 per year. Add car payments, insurance, utilities, groceries, healthcare premiums, student loans, and credit card minimums. Fixed expenses often total $45,000 to $50,000 per year. What's left is $5,000 to $10,000. That's for everything else: clothing, entertainment, repairs, savings. If anything unexpected happens, a medical expense, a job loss, a major repair, there's no buffer. Because you're in debt, you can't save. Because you can't save, you can't handle emergencies. Because you can't handle emergencies, you borrow more. The loop closes. Each time you borrow, your fixed monthly obligations increase. Your discretionary income shrinks, and your vulnerability to the next shock grows. This is structural. It's not about individual financial literacy or discipline. It's about the relationship between wages and costs. If wages rise slower to hand the cost of housing, healthcare, and education, and if credit is readily available to fill the gap, then households will borrow. And once they borrow, they're locked into debt service that reduces their ability to escape the cycle. Now, let me show you who profits from this loop. The answer is the institutions that manage the debt. Banks, credit card companies, mortgage lenders, student loan servicers, and the investors who own the securities backed by your debt. When you take a mortgage, the bank sells that loan to Fannie Mae or Freddie Mac. They bundle it with thousands of other mortgages and sell bonds backed by those loans to investors. Pension funds, insurance companies, foreign governments. These investors collect the interest you pay every month for 30 years. The bank collects fees. The servicer collects fees. And you pay interest that often doubles the purchase price of your home. When you carry a credit card balance, you're paying interest to the card issuer. But that issuer is often owned by a bank holding company that also manages investment funds. The interest you pay becomes revenue. That revenue is distributed to shareholders. And the largest shareholders are asset management firms. Vanguard, BlackRock, State Street. These firms manage trillions in assets. They own shares in the banks that issue your credit card, the hospitals that bill you, the insurance companies that collect your premiums, and the landlords that own your rental property. The entire loop funnels wealth toward these institutions. Student loans are slightly different. Most are owned by the federal government, but the servicing, the billing, and collections is contracted to private companies. Those companies profit from fees and penalties, and the interest you pay goes to the Treasury, which uses it to service federal debt. The loop connects. Your debt service funds government operations, which borrow from the same financial institutions that lend to you. It's circular. This is the structure. Households borrow. Institutions collect interest. That interest becomes profit. Profit becomes dividends. Dividends flow to the largest asset managers, and those managers own the companies that employ you, charge you, and lend to you. The loop is closed at every level. Now here's why this matters to you right now. The loop is accelerating. Real wages for most workers are flat. Housing costs are rising faster than income in nearly every metro area. Healthcare premiums increase every year. Student loan payments resumed in 2023 after a 3-year pause. Credit card debt just exceeded $1 trillion for the first time. And interest rates, after a decade near zero, have increased. That means debt service costs more. If you're in the loop, your monthly obligations just increased. If you're not in the loop yet, the pressure to enter it is growing. Because wages aren't rising fast enough to cover rent, transportation, and food without some form of credit. And the institutions that profit from the loop are more consolidated, more powerful, and more embedded in the economy than ever before. Here's what this means for you personally. Awareness is the first tool. Understanding that the loop is structural, that it's not a personal failing, changes how you navigate it. You can't escape the loop entirely, not without extraordinary income or inheritance. But you can minimize how deeply you're pulled into it. That means recognizing that credit is a product. It's sold to you because it's profitable for the lender, not because it's good for you. Every loan, every credit card, every financing offer is designed to maximize long-term revenue extraction. The system wants you to borrow and to pay slowly. Awareness means treating credit as a tool to be used carefully, not a supplement to income. It means understanding that the big 3 expenses, housing, healthcare, education, are the primary mechanisms of the loop. If you can reduce exposure to these costs, you reduce the pull of the loop. That's not easy. It often requires trade-offs that feel like sacrifices: smaller living space, fewer medical interventions, alternative education paths. But the structure doesn't change. The loop remains. And minimizing exposure to high-cost debt reduces the long-term drag on your income. It means recognizing that wage growth, for most workers, will not outpace cost growth in these categories. The gap will persist. The system is not going to rebalance on its own. Corporate profit margins are at historic highs. Shareholder returns are prioritized over wage growth. And financial institutions have no incentive to reduce lending. The loop is profitable. It will continue. This is not financial advice. This is pattern recognition. The loop exists. It was built incrementally over decades by institutions solving their own problems. And it functions now as a permanent feature of the American economy. You are living inside it. Your parents lived inside it. Your children will live inside it unless the structure changes. And structural change requires political and economic pressure that currently does not exist at scale. So what do? You see the loop. You understand how it pulls you back into debt. You make decisions with that awareness. You recognize that the system is not neutral. It's tilted toward creditors, and you navigate it accordingly. If this changed how you see your paycheck, your expenses, and your debt, if you understand now that the loop isn't a failure of character but a feature of the system, then you're starting to see the structure beneath the surface. Subscribe if you want to keep tracking these patterns, because they're not going to teach you this in school. They're going to teach you to budget, to save, to manage your credit score. But they won't teach you that the loop was built to keep you borrowing. That's not part of the curriculum, but it's the reality. And once you see it, you can't unsee it. The closed loop is real, and it's working exactly as designed.